Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I provide online valuation services for mediation and litigation based in St. Louis, Missouri. Today, we're actually going to discuss a buyer's perspective and risk factors in business valuations with Al Danto. He has over 30 years of experience with startup companies, entrepreneurial companies, as well as expertise in the acquisition, valuation, and divestiture of business interests. He has served as a representative for a multitude of engagements. He has experience working with lenders, private equity groups, and individual purchasers or buyers. And he served on a variety of boards, including the alumni board of the Graduate School of Business at Rice University. He is also a full-time professor at Rice University, and he's a member of the NACVA, which I am also a member of. So welcome, Al. I think what happens with business owners is they just don't know about this process. They don't know what a buyer is going to look at. But we have to go back and kind of remind everybody that valuation, an income approach or a market approach, which is usually the two approaches that you're looking at. But the income approach is like cash flow, which we're always focused on. Like, what's the EBITDA? What's the adjusted EBITDA?
Right.
But then the other piece of it is what is the risk that cash flow would continue? And so I think that, during this process, you have written a ton of articles and white papers about the risk component, both real and perceived, in valuation. So can we kind of get started discussing, and we might have to switch to the next slide. But tell us more about that.
Okay. So absolutely. So you're exactly right. And the job at the end of the day of a valuation professional is really to say, how risky is this potential investment, right? Because we have to say, okay, what level of return do I expect for the risk that I'm taking? So, you can start with something risk-free, treasury bills, and build up to bonds and build up to equities. But then you get into a privately held company and you say, okay, what return should I get for the risk that I'm taking for my capital? So, to all the business owners out there, this is kind of the takeaway, the silver bullet, is that to increase your value, certainly you increase your cash flows as much as you can, but, you have to remove this risk, and that's going to give you a higher relative value. So this is I'm a guy that drives a car till the wheels fall off, right? I mean, I just do. We just drive till the wheels. It's always been that way. This is my 2012 Ford Explorer. It's got 212,000 miles on it. I've never had a problem with it. Never. So to me, it's dependable. It's risk-free. It starts every time I turn the key, and it's But what is this to somebody from the outside looking in? Mm-hmm. It's an old beat up used car. They're going to want the lowest possible price for it because of this risk that they perceive. But I've never had it break down on me going forward. So it's dependable to me. And that's the way that business owners, you get numb to the risk that's in your business, right? Because you live it and you're there day in and day out and you see it. But someone from the outside looking in is going to see it completely different. So these risks are kind of magnified, and we'll get into it a little bit later when we talk about how do we improve our valuation.